Egg yolk, what's going on with the viewers of the tube? I hope you're ready for a wild and wonderful ride, because we are going to break down the crypto market so you don't have to. Bitcoin, are we going to stay bullish? Ethereum, why is it having a tough time, especially with gas prices? All those questions will be answered in about 10 minutes because it's time for chicocrypto. So what is up with Granddaddy Bitcoin? What are the technicals saying about BTC? Well, last Friday, I posted a pretty dang technical video and showed that with the 3 bearish days, 3 daily red candles, which brought the price down to the 44K range, we had fallen under the 200-day MA, moving average indicator, after just breaking over it. This is a long-term indicator of bull or bear markets. Above it signals bullish, below it signals bearish. And for the past 3 months or so, we have been below, and the recent break above it was a sign that we may be out of the bearish woods. But falling back under after just testing it wasn't good. But then we had weekend bullishness, which got Bitcoin back above 47K, and it pushed it above the 200-day MA once again. But as of early morning yesterday, the price was falling back down to 46K, hovering around that level and getting close to falling under the 200-day MA once again. The blue line in this chart is the 200-day MA. If Bitcoin is able to close above 45.5K and stay above that as of today, Monday, we are bullish as the weekly candle closed above this technical indicator. I shoot my videos 24 hours in advance, so I'm crossing my fingers for us all that we are above 45.5K today. Hopefully I'm not completely wrong by the time this video goes live. Although it's obvious from the price jumping above and then below the indicator, the bears and the bulls are in a big fight. This could go on for another week, hanging around this indicator, jumping above, falling below. But based on some things in the space, I think 50K BTC is coming really soon, possibly by next week. Or late this week by Friday. Why? Well, yesterday another big Tether print happened, a $1 billion one. This is the second time in a week that a $1 billion mint of USDT has happened after the printer was quiet for over 2 months. And on both occasions of the prints, the CTO of Tether, Paulo, tweeted, "Note, this is an authorized but not issued transaction," meaning that this amount will be used as inventory for the next period issuance requests and chain swaps. They are minting or printing in anticipation of requests for USDT throughout the end of the year. Everyone in the space knows having the Tether printer go quiet is a sign that the markets are going bearish and a cool off. Having the printer turned on means the markets are going to fire back up. Let's just look at the Bitcoin price over the past year with Tether's market cap side by side. As you can see, since December of last year, the Tether printer went wild, and so did the Bitcoin price. The markets, when they cooled off and crashed, was when the Tether printer went sideways. We are having a bullish divergence since the bear market, and as you can see, the Tether printer is also having an uptick. A small, slight one, but it's an uptick nonetheless. But now let's talk about Ethereum, the second biggest cryptocurrency. Ethereum has almost 2x'd in under 30 days, reaching a low of about 1700 July 19th, and as of yesterday was near 3200. That puts Ethereum just above $1,000 away from its all-time high of just above 4,300 set on May 12th. It's down just about 25% from its all-time high. Bitcoin, on the other hand, is about 30% down from its all-time high. So Ether is outperforming its precursor. I wonder why. Well, to understand why, we have to go watch that burn. As of yesterday, it had only been 10 days since EIP 1559 and the burn upgrade went live. And look how much Ether has been destroyed. Over 46,800 Ether, which is a USD value of over 148 million frickin' dollars. 10 days, 148 million. If that rate keeps up, there will be 1 billion Ether burned in just 70 days, just over 2 months. This is so amazing to see, Ether getting burned. But it's a double-edged sword. The burn rate increases, it means the more Ethereum is being used. The more Ethereum is being used, the higher the gas fees are on the Ether network. Doing a swap on Uniswap cost you nearly $50 yesterday for just a slow or average transaction. If you wanted fast, I took a screenshot. You were paying over $100. Yeah, that is double, and it's unsustainable even at the slow speeds. $50 for a swap isn't okay. And that over $100 for a fast isn't correct. It's MetaMask funking up with their calculations. So what the freak is going on? Will there be some relief here soon? And why is MetaMask shatting the bed so bad with their calculations? Well, Vitalik Buterin created a post within the Ethereum subreddit which explains just this. The post was titled, "Why has the chain capacity increased by about 9% after London? 3 answers." Vitalik's post says, looking at the daily gas use chart, we can see the average gas used per day has increased from 92 billion to 100 billion, a 9% increase, which we can confirm by looking at the chart. So why the increase in capacity and the gas prices are high? Vitalik explains, I think that the effect is roughly evenly split between 3 different causes. Number 1, ice age delay. Number 2, pre-London blocks being not full. And number 3, imperfections in the base fee adjustment formula. Vitalik then below explains each of those reasons in the most smart Vitalik way possible. Hard to understand for your average Joe, but I'll try and break it down for those who can't understand Vitalik. So number 1, ice age delay. Well, to understand this reason, we need to know what the ice age is. This refers to a mechanism, the difficulty bomb, that at a predefined block number increases the difficulty level of the puzzles in the proof of work mining algorithm, resulting in longer than normal block times, and thus less ETH rewards for those miners. This mechanism increases the difficulty exponentially over time, and eventually leads to what is referred to as the ice age. That is, the chain becoming so difficult to mine that it grinds to a halt and stops producing blocks. As Vitalik explained in the Reddit post pre-London, the ice age and difficulty bomb was starting to just take effect. But there was another EIP included in London, besides the one everyone talked about, the burn one, EIP 1559. There was EIP 3554, which delayed the difficulty bomb 6 months until December of this year. So why delay the bomb in the ice age? Well, Nethermind tweeted about it. They said, EIP 3554 is part of the London hard fork, and it will delay the difficulty bomb on Ethereum until December, when proof of stake can hopefully be merged in. But what's the reason for the delay? Why don't we just remove the difficulty bomb so we don't have to worry about it? They explain below. First, it's a defense against attackers that fork Ethereum. Although changing the code is relatively simple, distributing clients like ours that ship with the code change is very difficult. Second, the other benefit is that it ensures there is continued maintenance and urgency for changes. If all core devs drag their feet with implementing changes, the difficulty bomb sets in and Ethereum becomes unusable. And finally, third, he says, perhaps most importantly, when the merge happens, it'll encourage everyone to hop onto the proof of stake system, or else they risk staying on a chain that is unusable. So by delaying this, you are giving in to the miners, but it has allowed more miners to stay on the network. Miners are important for the health of Ethereum when it's proof of work. The more miners producing blocks, the faster it goes, which Vitalik explains. Pre-London, average block times were 13.5 seconds, and post-London, average block times are back down to their long-run normal level of 13.1 seconds. This is about a 3% difference in block speed, which explains 3% out of the 9% increase in on-chain gas usage. What about Vitalik's second reason for the higher capacity in Ethereum, pre-London blocks not being full? Well, Vitalik explains this pretty well, so let's just read what he has to say. Pre-London, the maximum block gas used was 15 million, but not all blocks use the entire 15 million. An analysis from April suggests that about 2% of blocks were empty. Altogether, we might suppose a pre-London unused space of about 2 to 3%. Post-London, however, 15 million is not the maximum, it's the target. This means that if the average gas used including the empty blocks is below 15 million, the base fee will decrease until the average is back to 15 million. So this accounts for another about 2 to 3%. This is actually great news, as it means blocks are being filled like they are supposed to, and miners are not abusing the Ethereum platform to mine empty blocks like they were pre-London. His final reason is the worst of all, as allowing these imperfections are, yes, allowing another 3% capacity, but at the cost of what users have to pay. Remember how I showed MetaMask and its imperfect calculation, trying to charge over $100 for a fast transaction? Well, this is because wallets, dApps, and the like are trying to calculate off of an imperfect algorithm. This causes mess ups in calculations, and users are the ones who are suffering. I didn't make that trade. I'm going to wait until MetaMask is more in line with the calculations of fees, which is going to take some time as Ethereum works out all their kinks. No one said this was going to be easy, and gas fees might just be high until we get to the merge. December, where are you? Cheers. I'll see you next time.